Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski with Channel 4 in Palos Heights, and my co-host is Paul Munico from Ameriprise. Paul's going to give us an update. Paul, I realize what's going on in the market. Sometimes it's tough to give guidance to people and tell them what's going on and get them to understand. And I'm going to turn it over to you. I'll let you do the best you can, and when you're finished, I will talk about what's happening this morning from Ameriprise.
Thanks. Predicting the market is something I never try to do. It's often difficult and hard to get right. So I avoid predicting the market at all costs. So today I'm going to report on the car market, the auto industry, as a change in pace for a bit. Because I know a lot of people out there probably are looking for new and used cars, and they've been in short supply the last year. As new vehicle production has been constrained by a shortage of parts. Now, this lack of availability has led to sharply higher new and used auto prices. Now, prices that have been a key contributor to the inflation problem we're in right now. So looking back to March, new vehicle prices were a sharp 13% higher year over year, while used car and truck prices were a remarkable 35% higher. Now, there may finally be a light at the end of the tunnel for auto availability as prices, however, as auto production seems to be improving slightly. Recently, some European automakers reported improved chip supplies. And more importantly, actual production levels have been growing. Monthly U.S. auto assembly numbers, we show them on a seasonally adjusted, annualized basis. They have improved in the last few months. In fact, April's rate of 10.6 million units represented the first month above the 10 million unit level since January of 2021. April also represented a second month of solid month-over-month gains. Now, through encouraging a few months worth of data does not make for a confirmed trend, and we'll need to see further production gains before we're able to count this aspect of the inflation surge as a diminished threat. But we do have evidence to show that it may be trending in the right direction. But again, time will prove out in the future here.
Paul, have you noticed that there are more trucks on the street? And it seems like if you look at dealer lots, the new cars, new vehicles rather, they're mostly trucks.
You talking about passenger trucks or like hauling and moving
I'm talking
trucks?
about pickup trucks.
Pickup trucks? I think I
Four-door
do.
pickup trucks.
Yeah, it seems to be a popular
Very
car
popular,
or truck.
isn't it?
It does seem to be, yeah.
Yeah, more so than SUVs were. SUVs were a top, you see them often. Almost everybody has an SUV. Very few are sedans.
Now it's trucks, yeah.
Now it's trucks. Anyway, I want to mention, which I did not earlier, is today's report is as of June 13, 2022. And Ameriprise had sent the following to us. The U.S. stock index futures are under significant pressure with the NASDAQ down 3% pre-market and the S&P 500 set to open in the bear market territory.
That's something investors might not want to hear, especially after Friday's drop in the market. But based on your reporting, it looks like Monday may start out to be a down day.
It sure sounds that way. Markets in Asia are closed down, and Europe is trading near the session slow down about 2.5% at midday. And treasuries are moving sharply higher. I'm sure you're going to have a comment about this. The bear curve flattening at 2-year hit 3.15%.
Yep, treasuries are something people are going to keep an eye on to see how high they may go, especially with potential interest rate hikes from the Fed coming and the effect that may have on the stock market.
And the other I want to mention is the 10-year moved up to 3.24%. So, yes, basically what you've said. Bitcoin futures are under pressure, down 18% below $24,000. And WTI crude is minus 1.5%. good, and gold is a minus 1.2%. If we can get the crude down, gas prices will see a little bit of improvement.
If gas
going
prices
down.
come down, I think that's going to help a lot of people. But again, we have
we'll
to just
see.
wait and see, right?
The year-to-date market returns: S&P 500 minus 17%, Dow Jones minus 12%, Nasdaq minus 27%. And you expect that from all the things that we've been reporting for the last few weeks.
Especially with last week's market moves, you're right, what's expected.
Okay, well, thank you, Paul. Stay with us. We're going to be back with our show called Your Money. Paul has a interesting topic to share with us. Stay with us. We'll be right back. And we're back. Thank you for staying with us on our show called Your Money. And Paul's going to be talking about tax loss harvesting. And Paul, what does that mean, and how does it work, and what do we do to prevent future losses?
Thanks. Yeah, this is a topic definitely you'd like to discuss with your financial advisor and specifically your tax advisor before you take any action. But it may be time to just consider tax loss harvesting in your portfolio, and we'll dive into what exactly that means a little bit more. Watching your investments take a tumble like they have in the stock market, it's not any fun. But seasoned investors may look at that market volatility and the inherent ups and downs that come with it. It's a natural part of the process, and that historical trends show that market swings usually even out over time. Now, in the right conditions, a market drop can even present opportunities, such as with tax loss harvesting that we're going to talk about a bit today. Now, I'm not a tax advisor, but in general, this concept, if it intrigues you, talk to your tax advisor about it, particularly in light of the recent stock index declines. So here's some general things you need to know. A potential tax saving strategy is what the tax loss harvesting implies. So tax loss harvesting strategy applies specifically to investments held in taxable accounts. Since current taxes aren't applied to IRAs or workplace retirement plans, this strategy is not applicable in those accounts. The tax benefit of selling a security in a loss position is that those losses could potentially reduce your tax liability. So let's look at an example. Suppose you invested $10,000 to buy 1,000 shares of a stock for $10 per share more than a year ago. Today, if the stock's value dropped to, say, $8 per share, your initial investment is now valued at $8,000. Now, the stock may recover and eventually appreciate in value. But if you sell it today, you could claim a $2,000 long-term capital loss if held for more than a year. And then you got to decide if that's the right choice for you. The upside of tax loss selling. Now, one deciding factor is whether you have capital gains that can be offset by the losses you incur from selling securities in a negative position. Long-term capital gains, which relate to assets you've held for more than a year, are taxed at varying rates. It could be 0, 15, or 20% based on your federal taxable income level. If you had a $3,000 long-term capital gain to claim on your 2022 tax return, that would come with a federal income tax bill of $450 if your long-term capital gain is taxed at the 15% rate. Now, if at the same time you lock in a $3,000 capital term or long-term capital loss on a different investment, it will offset that gain and eliminate the tax liability with respect to that specific capital gain. Likewise, if you own mutual funds in a taxable account, they may pay out capital gains distributions this year, even if they are not performing well at the present time. those gains too can be offset by capital losses that you claim. Note that you may not need or want to offset capital gains if your taxable income in 2022 including the gains is $41,675 or less for single tax filers or married taxpayer filing separately, or $8,350 or less for a married couple filing a joint return. Now, taxpayers with total taxable income and gains below those income thresholds qualify for a 0% tax rate on long-term capital gains. Singles and married couples filing a joint return can use up to $3,000 of net capital losses to offset ordinary income, which is about $1,500 for a married filing separate tax filer. Beyond that, unused losses can be carried forward to offset potential capital gains in future tax years. Now, there are cautions to be aware of about tax loss selling. The downside to selling a position that has suffered a loss is that you can't purchase that specific security or one that is substantially identical to it for 30 days before or after the sale at a loss, without the possibility of running afoul of the wash sale rules and deferring the loss. So choosing to sell also means you sacrifice the potential to benefit from a rebound in the price of the security while you are out of the position. You want to be certain that you are comfortable not owning a specific security for a period of time that could be a candidate for tax loss harvesting. Most of all, any buy or sell decisions you make regarding your portfolio need to go beyond just the tax consequences. And as I've already said, talk with your financial advisor about how tax loss harvesting opportunities fit into your overall financial plan, and be sure to consult with your tax advisor as well to understand how these tax rules apply to your specific situation.
Boy, it's so important, Paul. I mean, you just touched on it, but it's so important that if you're in this situation, you really need to talk to a tax advisor, and to execute the right direction, talk to your financial advisor.
Yep, exactly. Like, I'm just giving some general points to think about here. All this stuff needs to be confirmed with financial advisors and tax advisors before you take any action.
If there's any question, Paul?
Yeah, individuals can call me directly at 708-226-3412.
Thank you again, Paul, for Paul Minical with Ameriprise Financial, and myself, Ron Jankowski with Channel 4 and Palo Heights. We wish you good investment day.